What a Friday we're starting off the day with. Made it back to not just 23K but 23,200 in trade yesterday. Yes, the Nifty implied open is indicating a bit of a quiet start, but let's just ignore that. Let's talk about yesterday's expiry day strength. Remember, it was the weekly expiry, and barring that one sign of a dip that you had, that maybe those opening moves are going to get sold into, from there it was pretty much a one-way move up, holding around almost 300 points towards close and finishing off at that 23,200 print yesterday. Oil and gas, FMCG, telecom, automobiles, metals, pharma, they all contributed to yesterday's move. Sure enough, there were signs of weakness as well within particular stocks and sectors, but we'll ignore that given that the broader market was equally lively, if not more. So good comeback, good strength from the markets. But yeah, the global cues, that's a different story altogether.
Yeah, you can, I think, looking at the kind of market momentum and inertia and the stage of the market we are in India, you can safely ignore global cues.
Yeah.
You could say, okay, yeah, I'll mark them, I'll measure them, but I would not react to them. So Wall Street had a day out, dollar index a little bit here or there, nothing meaningful in terms of the bond yield movement, and nothing, thankfully, has come on the Trump, at least on the tariff front. So you want to acknowledge global cues, you want to measure them, but you do not want to react to them. But the story is India. Let's look at it. Look at the comeback from the recent low. And the comeback from the recent low, let's look at that data, please. From the recent low, which is what markets made, and I'm talking about pure Nifty, I think the market rally, excuse me, has been nothing short of breathtaking. First, it was a function of short covering. Then, I think the market is clearly tilting towards long bias. The concerns in the world, or the concerns for Indian market, high dollar, strong yields, FI selling, short selling, all of them surely seems to be getting diluted. Now the question, Aisha, is that is this beginning of a new trend, or this is an oversold bounce which is bouncing back, and another couple of percent point, 2-3% here or there, maybe 5-7% on large cap stocks, will it run out of breath? There's no decisive answer because markets are not exactly bombed out in terms of valuations. Earnings will recover, but they will not. They will recover gradually, and global terrain, which is looking stable today, could be topsy-turvy depending on what actually comes out from 2nd of April. My personal sense, Aisha, is that I think this market will be in a healthy shape at least till 2nd of April. And I'll tell you why. Because there is no other news. Second, large part of the market is still short. And see, the high frequency data points, at least locally, have been strong. And considering that FI positioning is still short in the market and the average institutional investor is still short, they could be forced to cover their short positions. I doubt that some of these hedge funds and FIs, they will run into the event with a short bias when you have a 2nd April deadline coming in terms of tariff. So I think short covering, the FOMO effect, and some repair work in mid-cap stocks, I think is at play now.
Let's just take stock of not just the global handover, which has been a little bit weak, but how Asia is panning out. And just look at Hong Kong and Shanghai, because those two markets have been on quite the losing streak for the past 2 trading sessions. And today is no different. We're down about almost 0.6%, equating to near about a 150-point fall on the HSI. And Shanghai as well is a little bit tempered in trade. Japan, though, mildly higher. So it's a very sedate market that you're currently staring at. But yes, for our markets, it's been a one-way move up. So touch wood to that. Whether it's going to sustain or not, like Nikunj was saying, that's anyone's guess. We've seen a 5% meaningful bounce from those, March 4th lows. Will this gain get, or this uptick get sold into? Is it just a rebound of a tactical nature, or is it more sustainable and durable? We'll see what happens come April. But other than that, what's really on our radar this morning is, of course, Accenture's numbers. And I think, Nikunj, first for the viewers, we really need to establish, while some of those Indian IT ADR stocks did fall a fair bit overnight, but whether or not there is any correlation between Accenture and the Indian IT services plays.
Accenture is, I mean, sometimes it's one, sometimes it's two, but it is one of the top IT companies in the world. Accenture numbers, they tend to act as an indicator of what really lies ahead. And for the first time, Accenture has gone on record, and I'm reading the con call highlights here, and then I'll talk about the connection here. These are con call highlights from Accenture in my hand. By the way, where was the stock yesterday? We'll pull it out. FY25 guidance, organic growth of 2 to 4% and inorganic contribution of 3%. The CEO has warned that Elon Musk efforts to slash US spending have started to affect its revenue, with the consulting group also highlighting there is a threat for global economic uncertainty. The management is confident of a guidance of 5 to 7% with minimal impact on performance despite slow discretionary spend. Now, historically, whatever Accenture has indicated, directly or indirectly, it tends to act as an indication for TCS, for Infosys, and for HCL Tech, which is that if in August 2024, Accenture had reported a growth of 4%, TCS reported a growth of 2%, Infosys 3%, and HCL Tech 1%. So by and large, whatever Accenture in a sense has always indicated, that tends to be the broad thumb rule for the IT sector per se. And the news from that front is not great, which is that Accenture is feeling the heat of the new normal. And if Accenture is feeling the heat of new normal, Indian IT companies will also feel the heat of new normal. What is the new normal? Well, we actually thought the new normal was AI. Actually, the new normal is Elon Musk and the way he's trying to cut costs, and which is going to be having impact on the economy. So AI, everybody saw coming. AI is a wave, and by the time you realize it, by the time you understand it, you say, okay, it is something I can predict, I can understand, I can calculate. But when Elon Musk happens, it shocks everybody, and that is what Accenture seems to be indicating. See, I try to put it very simply. Why has US economy done well? Because they've printed their way to prosperity. US administration wants to bring their fiscal deficit or the debt under control. They are doing that by cost cutting, which means that you would be spending less. If you would be spending less, wherever the effect of spending was there, all those sectors in a sense will see and they will start slowing down. So directly or indirectly, whether it is AI, which is productivity, where the focus would improve, and cost cut, which will affect the existing business. I think that's the new normal, which every IT company will now have to reconcile with, and that is what Accenture is saying. IT, I've been hopelessly bearish last year. I got it wrong. But I continue to maintain that for a sector which is growing at 5 to 7%, why would you give P multiples of 20? I think the stock will react today across the board, and let's take it from there.
If you like this video, then like, share and subscribe to ET Now.